Hey guys, how's it going? Everyone can hear me, right? Yeah, I agree, Regan. I'm going to talk a little bit about uh, government and the political outlook because it's so strongly correlated to the market right now. So it definitely matters, and we should all be aware of what's going on within the government and politics. So yeah, okay. So we don't have 10, but that's kind of sad. But we had 8, now we have 7. We're just gonna start. Hopefully, we can get more people. It was like 14 people in the chat, so there's only half the people here. And obviously, I think one of me in the chat is me in the chat, so it's 13. But all right. So, guys, I want to start this off. Before we even get into anything, I want to start this off with talking about how important it is to make sure, okay, like I said, I'm going to always drive home these things every time I have a chance to talk to everybody, because I still see, it looks to me like there's some people having struggling still and having some difficulty. So, and even if you're not, it's still, I feel like as me, my job is to drive home things that I think are very important. I see myself as a coach. Like I said, I love sports, so it's the same way. I have a son and a daughter, and I coach their sports. It's the same idea, right? I have to drive home things that I think are important. So I'm just I already have all this stuff on the top of my head. I say it all the time, but I really want to emphasize it because I feel like not everyone follows it all the time. The first thing I want to say is, okay, weeklies, guys. So some of the trades we send out on the website, we send out, Dave likes to post weekly trades, which is fine. But you have to understand that if you're going to hold weekly trades overnight with weekly expirations, that's super risky. And if you're going to be holding those overnight, you should only be doing that with a real small percentage of your account. Okay, when I say small, I mean, you need to understand when you're holding a weekly trade, like front week a weekly trade. I mean, basically, you're holding a trade that expires this Friday, overnight. When you're holding trades like that overnight, that's super risky. You need to understand that everything you have in that trade is possible that you're going to lose it all. So you have to understand that first and foremost, and then second off, you have to structure your trade off that. You have to understand that all of that's at risk. So if you have a $10,000 account and you understand all that's at risk, maybe $300 or $400 max is what you should have in weeklies that you're holding overnight, max. And this is why. Okay, so when you see when you see Dave post his trade ideas, Dave's a great trader. He has a lot of his trades work out. The past couple weeks, the market's been choppy, so it's been tougher. But when you see Dave post his trades, you don't necessarily have to make the exact strike and expiration. If you want to be less risky, right? If you want to take less risk, you can use that idea and still go out longer in expiration in a higher delta. This way, you're being less risky, but you're still using his idea. Everyone has their own trading strategies, and that's fine. And I want to make sure that everybody is protecting themselves from drawdowns and, protecting your capital as much as possible. So I've done I've made all these mistakes in the past. It's just, I just don't want to see people holding weeklies overnight with a large portion of their account. That's really risky, and you shouldn't be doing that. So this is why I say, okay, this is why I'm leading into this. This is why I say, on expiration, I think everybody should, especially newer people, everybody should be going out 30 plus days in expiration, and your delta should be 50 or higher. This gives you a lot more time to realize a good idea that's, Dave's ideas work out a lot, and if you take one of his ideas, and like I said, if you just take the idea and you structure the trade with the longer expiration and a higher delta, the idea can still work fine. It doesn't have to be the exact trade that he gives you, because with weekly trades, like I said, with weekly trades, you don't want to be Like, you want to be risking a max like 2 or 3% of your whole account on a weekly trade. Like, that's all you should be holding in your account in a weekly trade, is like 3% of your account max. So if you have a $10,000 account, like $300 is what you should be holding in weeklies. That's it, overnight. And now if you go out over 30 days in expiration in a higher delta, now you can, if you have a $10,000 account, it's safer to put like $1,000 into that trade. And then now you're not risking the $1,000. You're risking, you could say you're risking 50%. So you're risking $500. You put 1,000 into that trade and you're risking 500. So you're risking 5%. It's a lot safer to be risking 5% when you're going out 30 plus days in expiration in a 50 delta, because you're giving your probability of success on the trade, you're giving yourself more time. And so it just makes more sense. I just want you guys to protect yourselves. It's never bad to be, have a little bit in the weeklies. And the bigger your account, the more you can put into that. But I just don't want to see people get, hurt themselves unnecessarily. And I just need to drive home how important money management is. I'm not saying that. We all know that Dave's trades work out a high probability of the time. I'm not saying anything to go against it. I'm just saying, like, there's a certain threshold where you should no longer be holding like weeklies in your account. And that threshold's very low, because you don't want, like, that's the riskiest form of trading that you can do almost. So we really need to drive home how important money management is. And yeah, I'm just starting. So the 50 delta and the 30 plus days in expiration, that can be done no matter what idea comes out. You can still take the idea of the trade and structure it your way with whatever strike and expiration you want, and make it more safe for yourself if you already have too many weeklies in your account, is what I'm saying. I never want to see. I would never want to see someone's account loaded up with weeklies. I would never, so the way I think is if I would never recommend somebody else to do that, then I wouldn't do it myself. Like, that's like the best, I feel like that's like one of the best tests you can have for yourself in the market. Because sometimes I'm more apt to take more risk when it's me. And so if I step back and I view myself in the third person and I say, would I recommend somebody else to make this trade? That forces me then to see, okay, I would never recommend somebody else to do this, so then I shouldn't be doing it myself. That's kind of how, like, if I'm ever on the edge of, because I am pretty risk averse, so sometimes I take too much risk, and if I feel like I'm prone to that, I'll always step back and be like, okay, would I recommend somebody else to do this? Because generally for me, I always want to, I wouldn't recommend anything to anyone else that I think's super risky, So yeah, I think it's always good that's like part of the psychological and mental aspect of trading, is being able to see yourself in the third person perspective, like step back and see yourself objectively, where like Steenbarger, he's a trader. He has his PhD in psychology. I've shared his blog a couple times. I'll share it again today. I've read a couple of his books, Psychology of Trading. It's a great book. But like, he uses a great example where like, step outside yourself and view yourself. Like, pretend like you're observing yourself. Like, step outside yourself and pretend like you see yourself from the third person sitting at your desk trading, and then observe, like, am I acting rationally? It's a lot easier to see it from that perspective if you step outside yourself and be more aware. That's why the psychological aspect of trading is so important. And then, discipline, having rules. Actually, I think I mentioned this earlier, but I have so many rules that I follow, and I really need to share those with you guys. But a lot of the rules that I follow that I need to I've already shared with you guys. The most important rules that I follow are the ones that the most important rules that I really try and live by are a lot of the ones that I've already been trying to drive home with you guys. It's just in my subconscious, and I don't even have to. It's like I don't have to look at it. I just know. But it's good you should always have your rules for yourself, trading rules. And plans, a trading plan. I'm going to give you guys an example of a plan today. How to plan a trade on your own correctly, in my opinion, to make sure that you're protecting yourself first. Okay, I want to drive this home too. Okay, so I say 50 delta, 30 plus days in expiration. I want to drive this home as well. Our number one goal as traders is not to make money, okay? Our number one goal as traders is to protect what we have, okay? Our number one goal as traders is to protect our capital, okay? We need to keep ourselves in the game for when things get really interesting and volatile. We have to have enough capital in the game to profit from that, okay? And this is the other thing, like only a third of the time is the market trending strongly in either direction. It's about only a third, about 35% of the time, I think is the number. So the other 65% of the time, the market is not moving decidedly in either direction. And that's a tough time to be trying to make a lot of trades. And we're in that period right now. But it looks like when we're gonna go look at the Fibonacci's. I'm gonna talk about the Fibonacci's a little bit. But it looks like we might start trending down. But we've been in that period for the past like 3 weeks where we've been in that cycle where we're not moving. And that's more common. That kind of cycle is a lot more common than a trending cycle for short term. So when we're in a cycle like that, people need to be more aware of that and also need to take less risk and be ready to lock in gain. When in a range bound market, you need to be ready to lock in your gains faster. And just risk less because it's just not as good of an environment to be putting on a lot of trades. I'm actually going to step out and see if you guys have any questions. See, I think it's so important to talk about all these things over and over again because I don't want anyone. We on the Standard Oil Exchange, we care about all you guys. Okay, we want you guys to be successful. Therefore, there's some things that I feel like I need to I just want to keep driving home so everyone gets it and everyone does it. Everyone follows it. So Zach, a weekly is an option that expires front week. Okay, I mean it doesn't matter what day it is. If you buy, okay, I'll give an example, right? So Monday's the 27th. Okay, so if you buy a March 31st option, that's a weekly right now. So if you on Monday, if you buy a March 31st option, that's a weekly. I'm telling you, you should not be holding weeklies overnight with more than like 3% of your account max. Okay? And that's like a 3% like total because you can easily lose everything you have in that weekly trade. It's super risky to hold weeklies overnight. Okay? And I think on the Standard Oil Exchange, a lot of the time we're just assuming that you guys are using proper money management, but like money management is the most important aspect of trading. I could spend like hours just talking about money management and how important it is to be disciplined because nothing else matters. If your money management is poor, you're gonna blow yourself up with options like so fast. So when I say weeklies, I mean if you buy a March 31st option on Monday, that's a weekly. I'm saying you should not be holding weeklies overnight. And even I think you should not be holding anything inside of 30 plus days of expiration overnight with more than 3% of your account. A weekly is like, the longer you go out, the safer it is. But a weekly is like that's the most risky of the risky. And you got to make sure that you're not leaving yourself so susceptible to too much risk. And you can't be holding too much of those as a portion of your overall portfolio and as a portion of your overall account balance. So that's what I mean by weekly, Zach. A weekly is front week, okay? It means it expires this Friday. That's what a weekly is. And yes, I'm saying even on Monday, if you buy a weekly on Monday, I'm saying you should not be holding that overnight with more than like 3% of your account max. That's what I'm saying. No problem. Okay. So now we're going to just go into something. But I wanted to make sure, because I know that people have been saying they've been having some trouble. And, that makes sense because this has been a tougher market the past couple weeks. And so this actual cycle that we're in right now is a prime example of why it's so important to have money management, because if you put on too much risk at a time like this, you'll blow yourself up, or you'll lose too much of your account. And then when we start trending again, you'll spend that whole time that we spend trending just getting back to where you were before you decided to blow out most of your account at a time when the market wasn't doing much. If that makes sense. It makes perfect sense to me, but the way I explained it maybe didn't make sense to everyone. But I hope that you guys follow me with that. Basically what I'm saying is the last thing you want to do is put on a bunch of risky trades at the wrong period of time where the market's not trending in either direction. And then you end up losing like 30 or 35% of your account at that time. Then we start trending again, and you spend that whole time making back all the money you lost instead of profiting. So like, that's why it's just so important. Yeah, Zach, I'm saying like, basically, I would say like this, anything inside of 30 days. Okay, so weeklies, I would say is like their own thing. Weeklies, I would say 2 to 3% max of your account. And then I would say anything inside of 30 days would be like another 2 to 3% of your account. And then 30 days plus is when you can do like, it's safer to hold like, you could put like 10% into a trade and be risking half of that, right? So you could, if you have a $10,000 account and you're going out 30 plus days in expiration, you could put $1,000 into that trade and be risking half of that, be risking 500, right? So I'm saying anything outside of 30 days, 30 plus days is 5%, okay? You can risk 5%. And when I say risk 5%, that means you can put like 1,000 into that trade and risk half of it, right? And you lose 50% of the trade, you're losing 5%. Now, anything inside of 30 days, I think you should just be like, whatever I put into this, I'm risking, because it's just so much more volatile and risky that you shouldn't do it like I just explained with the outside of 30 days. I think especially with weeklies and like 2 weeks, it should be like, you should just assume that anything you put in that trade is at risk. Whereas if you go out 30 plus days, you don't have to assume that everything you put into that trade is at risk. You can assume like half of what you put in that trade is at risk. So you can put more money towards it, if that makes sense. So yeah, I really just want to, and the thing about it, guys, yeah, is it going to be a little more expensive to go 30 plus days? Yes, but it's still the best way to make, options are still the best way to make a lot of money. So just because you're not taking like a ton of risk, you're still taking a decent amount, but just because you're not taking the max amount that you could possibly take, doesn't mean that you're going to not have you'll still have great returns if the trades work. You just will have a little bit less, but on the same token, you're protecting yourself more, which in my opinion is the more important of the two, to protect yourself more, because everyone cares. Like, it sucks losing money. You have to hate losing a lot more than you like making money to I guess to agree with what I'm saying. But if you trade long enough, you'll realize that you do hate losing a lot more than you care about making money, because it just, losing money sucks. All right, it just you have to hate losing a lot more than you like to profit. And eventually I think eventually everyone does, once you have a couple, setbacks. Okay, so now we'll just go into Fibonacci's. So we started at 9:15. Okay, so we've been going for like a little bit more. So I just spent like 15 minutes coaching. Okay, I pretty much just spent 15 minutes coaching and not doing any training, but I think that the coaching that I just did is more important than anything. So I hope that everyone agrees with that. But either way, if you don't, it's still information that can help you if you allow it to. Okay, so we're going to talk about Fibonacci's today. And I'm actually going to go into a little bit more detail about why it works and how it works. And why it's so important. So, okay, here we go. So The Fibonacci retracement levels, actually, this was invented by a fellow named Leonardo Fibonacci, I believe in like the 14 or 1500s. And what he found was this golden ratio that applies to everything in the universe. So conversely, it's found in the stock market as well. But it's such a crazy thing that like this ratio is found everywhere. So for a couple examples, if you take a beehive, if you divide the amount of female bees by male bees within a hive, you get the golden ratio. If you take, it's found in sunflowers, it's found on the human body. Like if we measure from our head to our feet, then divide by the length of our belly button to our feet, you get the gold. Like it's just crazy how the golden ratio shows up everywhere. So the golden ratio, being the fact that it shows up everywhere, it obviously shows up in the stock market as well. And then the big things with the golden ratio is the 382, the 50%, and the 618 retracement levels. So these are what the Fibonacci's are. And it's created, so the way that you get these Fibonacci levels, it's created by taking two extreme price levels, from a high to a low or from a low to a high. So you measure a swing high to a swing low, or you measure a swing low to a swing high, and you get retracement levels on that swing. And what this is basically saying is that after any big swing down or swing up, you're going to get a retracement back in the other direction. It's just like the law of the way the market trends in the market works, which is why in my opinion, you should never be buying into a huge rally or selling into a huge sell-off. You should be waiting for a retracement before you enter, if that makes sense. It makes sense to me, and I think it'll make more sense to you guys after we look at this. But so like basically what the Fibonacci retracement levels is you take the swing high. In this example, we're going to take a swing low. We're going to take a swing high to a swing low, and then we're going to look at the levels. But those levels are where you should retrace to before you start heading back in that other direction. So yeah, okay, I think that's everything. And then once you get past the 618, that means that the actual swing, in this example, we're going to look at the swing low that we had. If we got past the 618, that would have meant that there's a much lower probability that we continue in the same direction. So, okay, first, you guys see this red arrow here? This is what we're measuring, okay? I'm measuring this big, this was last week. Why did this sell-off happen? For some reason, forgetting right now why this big move down happened. I don't remember off the top of my head. Obviously, I was there and I was telling you guys about it in chat, but I'm drawing a blank. But anyways, basically what we're doing. So this is daily candles on the E-mini, okay, on the futures. Okay, and this is another thing, guys. Another rule that I want you guys to follow. I didn't bring up at the beginning. I want everybody to make sure that they're constantly monitoring the E-mini, okay, because this is what drives the market. This is what matters, okay? So if you're trading intraday, if you're looking at the market intraday, you should always have on your radar like the 30-minute candles of the E-mini, because that's like the pulse of the market, and you need, no matter what stock you're trading, you need to have this on your radar. Gives you like the pulse of the market, okay? So what I'm measuring here, we're going to go to the next slide in a second, but basically the way it works with Fibonacci's is you measure from a big swing high to a big swing low. So this big move down that we had last week, I'm measuring from the high of that down to the low here, okay? So that's what we're measuring for the Fibonacci's, and it's going to be zoomed in, but we're taking it from the daily first. These are daily candles. We're measuring the swing high up here to the swing low down here. Okay, so now these are 30-minute intraday candles on the E-mini. So that same thing, we're taking the swing high to the swing low. And what we get is these levels, right? The 382, the 50%, and the 618. So basically, after a big impulsive move, we can expect anywhere from 38.2% of it to 61.8% of it to be retraced before we head back down in the direction from whence we came. So what happened, what we saw here is last week we made this big impulsive move down, and we retraced pretty much exactly to the 50% retracement, right, of 23.55. And this is why in chat last week I was saying to make sure to watch 23.60. This was on the E-mini, so on the S&P it's a little bit higher. There's like a 4 or 5 point difference between the E-mini and the SPX, the actual S&P index. So it's probably like 23.65 on SPX. But I was saying, 23.60, 23.65, if we close above that level, right, this is the 618. So this is an example of how the 618 works. It's like that threshold where if we closed above it, there would have been a much lower chance of us starting to go back down again. At that point, if we, on this big impulsive move down, if we come all the way back up and retrace above the 618, that means there's a higher chance now that we're not going to keep going down. It means that like this big move kind of just got invalidated with these Fibonacci levels, and there's no longer a higher chance that we're going to start trending down again. But what we did see last week is we came to the 50, we retraced perfectly to the 50, and then we started coming back down. And we actually closed outside of the 382. So we closed outside of the Fibonacci's last week. What that means is after we come down and then we retrace and then we close back outside of the zone, now this means that there's a pretty good probability that we're going to make another leg down after we close outside of it again. So we close below 2350, right? So this retracement zone was from 2350 to 2360. And this would have been, when we started retracing, this would have been where I would have looked for an entry for a bearish entry. Instead of trying to buy into the teeth down here of the sell-off, I am always trying to wait for a retracement. I'm always trying to wait for a retracement and then make an entry once we get into the Fibonacci retracement zone. That's where you want to make an entry. And then, like, say if I was going to say, okay, I'm going to enter at around the 50%, then I can make my stop at the 618, and I'm risking $5. It's kind of like you can structure the trades off these levels. So what we saw was we retraced, and then last week we came back down. I think this was Friday. This is massive volume on Friday because of what was happening with the healthcare bill. And then we sold off and we closed outside of the zone. So now what that says is there's a good probability that we're going to make another leg lower, assuming that they don't pass the healthcare bill. If they actually are able to pass the new healthcare bill, that could change things dramatically, and we could just rip up to the upside. So it really depends on what happens with that, guys. And a lot of the time, headline and news like that will drive the market. And on Friday, they didn't get a deal done, so the market was thinking that they're probably not going to get one done at all. And Trump's saying, that he wanted to move on from that and go to the next thing. So if they don't get anything done, I think we're going to make another leg down, seeing that we closed outside of the zone on Friday. And if they do get a deal, I think if they do get a deal, the market's going to probably pop. But if they don't, then we're going to head lower. And this is just zoomed in even more, so you guys can see that. See if does anybody have any questions? Yeah. Yeah, the sell-off happened after they were saying, they don't think they could get a deal done. Okay, so those are kind of the Fibonacci's and how that's a good way of using them, especially after a nice leg down. You see, it's kind of like a strike zone, right? It's like, okay, we get this big move down. Now I want you to come back into my little strike zone here, and then I can look for a trade to enter, a bearish trade to enter, assuming we're going to continue this move down, this big impulsive move down, assuming it's going to continue. I want to see it. I want to see you come into my strike zone, retrace a little bit, and then I'll put on a trade. So yeah, and it's pretty. Should note that it retraced like exactly to the 50% level. before it started heading lower. So yeah, no one has any questions on that. Is that right? All right, I'm gonna X this out. So you go, if you're doing a down move, Zach, you start it at. If you're doing a down move, you start it from here and you swing it down to here. So if you're in Thinkorswim, it's in the drawings. You can get it right from the drawings. You go to Fibonacci, you take it, you start here, and then you bring it down to here. It's going to give you all these levels. You can customize it any way you want. It's going to give you a bunch of levels. I customized mine so it only gives me these 3, and I made the lines thicker and I made it show the price level. You can customize it however you want. You can and then you can manually enter in the price levels to get it exact from the high to low. So on a downward Fibonacci levels, you go from the swing high to the swing low. And then if you're going on a uptrend Fibonacci, you go from the swing low to the swing high. All right. Well, do I always use 30-minute chart on the E-mini? Yes, I like my time frame of preference is 30 minutes on the E-mini. On actual stocks, I like to use on the actual equities and stocks. I like to use the 15 minutes, and sometimes I'll go inside of 15 minutes, like 5 minutes, or sometimes 1 minute. But usually, I just use 15 minutes as my intraday time period of preference on stocks, and then I use the 30-minute on the E-mini. Yeah, Odin. Tax reform will be great for tax reform, and him easing regulations is the reason why the market rallied the way it did when he got elected. Now, some of the reason why the market is selling off right now is because it's seeing that he's basically can't get anything done, because like everything it has to pass through, it's just no one can agree on anything. So they're seeing that it's difficult to get anything done. So it's probably the market starting to price in the fact that maybe he won't be able to get tax reform done, or maybe he won't be able to ease regulations because it's just the market seeing that nothing is easy to get to accomplish. So that could be part of that as well. What is the best time frame for the fibs? It depends on what. Hey, 1 sec. SMA lines. Zach, by the way, I think you're asking some good questions. So good job with these questions. These are all good questions. These are all good questions by everybody. But Zach, you seem to be engaged today. That's good. I like that. Yeah, the debt ceiling has already happened too. So the debt ceiling's in place. The Fed can no longer grow grow its debt in treasuries. It's like capped right now, so it can't like grow its debt. The debt ceiling went into effect on March 16th. They have to get another deal done. But yeah, Odin, you're bringing up all these good points of news, which really is what matters in the market. The market cares about these things a lot. So the best time frame for fibs, Zach, is whatever time frame you're trading. I think most of the time on the San Diego Exchange, we're looking at the daily time periods. So it's good to do dailies. And look at that to start out. But if we're making because a lot of our trades are shorter term, like a couple days to a couple weeks, it's good to do intraday too. So I did the 30 minutes. I think 30 minutes is fine. You can like an hour chart, a 4-hour chart. But I think 30 minutes or an hour chart is pretty good to do it on as well. Assuming you're taking like a big swing in either direction, can really help you, give you a good idea of what's probably going to happen after a big move. Is the stocks can go back in the opposite direction and correct some of that move. And it just gives you an idea of where some levels are that it can go to before it starts trending again in the direction that it started. The numbers on my SMA lines. Yeah, so Zach, if it closes out of the 618, yeah, I'll wait. Like, I want to see it close on the daily out of there, and then, give it a couple days, a day or two, and see what happens. The longer period of time that it stays outside of the 618, the higher the chances that it's not going to start going back in that direction. The higher the chances that it's going to reverse and go in the opposite direction. So once it closes outside of the 618, like once it closes above here, and if it stays above here for a day or two, there's a much higher chance that it's not going to start going back down. There's a much higher chance that we're going to start heading higher again. If we climb up and above the 618, and we stay above there and close above there, and we stay above there for a day or two, there's a much higher chance that we're going to start going higher again. Just the probabilities shift. The probabilities shift in the other direction. And that's all you can really ask for in the market is probabilities, because nothing's ever guaranteed. So this is a really good way to give yourself an idea of the probabilities of what way we're going to move in the market. And the thing is whatever way the probabilities tell us we're going to move in the market, it's not going to happen overnight, right? It could take a week. It could take 2 weeks. It could take 3 weeks. This is why I say it's so important to go out 30 plus days in expiration, because you got to give it some time. It doesn't mean it's going to happen, like, just because we closed outside of the 382, we retraced to the 50 and closed outside of the 382, it doesn't mean we're going to sell off like tomorrow. It could be like, another week before we really make another leg lower. We could chop a little bit and then finally go down another week. That's why I say give yourself time with options, okay? You still have plenty of leverage. You have plenty of upside potential. You have plenty of... It's just a way better alternative to if you were just buying shares of stock no matter what. So, 30 plus days you still have plenty of upside. But that's why I say that. It doesn't mean it's going to happen like tomorrow. It just gives us the probabilities of the fact that we came, we retraced, we closed outside the 382. The probabilities are in our favor if we're bearish right now. If we have puts, the probabilities are in our favor that we're probably going to make another leg lower here next week or the next couple weeks. Okay. And yeah, if it came up and closed above the 618, now the probabilities shift. We're probably not right to be holding a lot of bearish positions at this point, because it's a higher chance now that we're going to start going in the opposite direction after we take out the 618. Okay, so yeah, Zach, the magic number is 618. In the whole golden ratio, the magic number is 618. But generally speaking, most of the time you get a 50% retracement. And that's really all you want to see, because the closer it gets to the 618, the higher the chances that move's not going to continue. Like the big move won't happen again. And the 618 is really the line in the sand that tells us, okay, this move there's now a lower probability that we're going to get another move down in this example. So yeah, the 618 is kind of like the line in the sand telling us that this big move down probably isn't going to continue. And then the 50% is like where you want to see it retrace to before you put on a bearish position. Like you want to see this come down. Okay, you say you miss most of this first move. It happened so fast. Now you want to assume that there's going to be a continuation. You want to see it come up to the 50 before you make a bearish entry. Okay, now these are good questions too. When and how to identify the price retracements. So that's kind of subjective. There's no rule for that, but if you look at the chart, it just makes sense. It's really the impulsive moves that you want to measure. So this move that we had on March 21st, this is what I'm measuring. And this is because we're short-term, right? We're short-term options traders. So I'm measuring this big impulsive move down we had from this high to this low right here. That's what I'm measuring in that chart. So it's really like you want to measure the impulsive moves. Whereas like bullish moves, they happen over a longer period of time. So like if I was going to measure the last bullish move we had, it would be from like this swing low to this swing high. It would be like what I would measure and be like, okay, I want to see it correct X amount before we stand up. Which actually, if you did that, we're probably in the 50% range for that as well. If you measure from the swing low on January 31st to the swing high on March 1st, we're probably pretty, I mean, I could do the math in my head pretty easy too. So the low here is 2267. So 267 and the high is 400. So 260 and 400, that's like 133. And then half of that's like 61. So 61 from here would be 2340, which is right where we are, right? 2340. So we're like at a 50. We're actually, if you measure this big swing up that we had, we're at a 50% retracement on that right now. So that's interesting too. If you took that and you looked at it, and then if we close below the 618 on that level, then it's even better chance that we're going to keep going. But that's just like a longer term. I still think we're going to get another leg lower. So that's why I took this move that we had was the biggest move we've had in like 115 days, right? A 1% move down, over a 1% move down. We had gone like 110 days without that happening. So this was a very significant move. So that's why I'm measuring from the swing high here to the swing low here. And you could make an argument that you go from the swing high here to the swing low here as well. But that's just going to give you bigger retracement levels. And I'd rather have it like the levels smaller, so I know faster. It's going to give me a lower 618 retracement level, which is just going to tell me that I'm wrong faster. I'd rather have it like that. So yeah, it's really just looking at the chart and measuring. And then someone asked, like, is there certain stocks it doesn't work with or certain ETFs? No, I mean, it works. It's not like a magic. It's not like a magic thing where it's like, okay, if it's here, it's going to be this. It's a good rule. It's like a good indicator to use to give yourself an idea of when the probabilities shift and where a good entry would be on it within a trend, right? I think you always want to be entering a trend within a retracement and not like chasing it when it's up, okay? Because you should never be doing that, right? You should always be waiting. Like if you want to enter a trend, like this is a pretty strong uptrend here. And then like here, right? So if you say we wanted to enter this uptrend, this wouldn't be a bad time as well to enter. Like this is why we're kind of at like a pretty key area in the market right now, because like longer term, this could be you could say this is a decent area to try some bullish trades. But me, shorter term, I think that I still think that this is a good bearish setup. So, I mean, there's right there how you can see that, like, the market is subjective at always. You can make a case on either side. And that's why, like, when I look at a trade, the first thing I do is like, okay, I like this trade. Now, let me look at the opposite spectrum and see how much I still like it, right? So I always look at, like, both sides of a trade, which I think everyone should do. So yeah, I mean, we're at a pretty key level right now. Like this, you could argue that this is a good entry for a longer term bullish entry as well, because we've had a pretty nice retracement. But the big move down that we had last week, I think that there's a good chance that we're going to get another. Usually you don't just get one impulsive move like that and then it ends. Usually there's more follow through than that. So that's why I think there's going to be more follow through. But I mean, you can make the argument in either direction right now, really. Because we haven't been trending for a while, right? We've been correcting for a while now. So no, Zach, I wouldn't wait till it gets to the 618. I was saying I would wait usually to the 50. I think a good rule of thumb is you can try an entry at the 50% retracement and then make your stop at the 618, because if it gets above the 618, then the trade's no longer going to work. If it retraces back up to the 618, I don't really like an entry up there, because it's just, once it gets up there, there's a lower probability that it's going to go back in the direction, that trending direction, if that makes sense. So Raghu asks, why am I not measuring from March 6th, which is right here? Is that right? Nope. March 6th. March 6th. Where's March 6th? Why would I do March 6th? I could see the argument for March 1st. I could see the argument for March 15th. I can't really see an argument for March 6th, in my opinion, because I'm measuring to this swing low. So yeah, you can make an argument I could do it here to here, or I could do it here to here. But like I said, the reason why I'm doing it here to here is because this gives me a more reactive Fibonacci like levels. They're all lower, right? So the 618 is going to be, if I measured it from here to here, the 618 would be higher. If I measured it from here to here, the 618 would be even higher. So if I measure it here to here, the 618 is a lower level, and it just gives me like kind of a more reactive probability. Like as soon as it gets to that 618, I know it's not gonna. It's probably a higher chance that it's not gonna work anymore. So for example, like if I'm measuring from here to here, the 618 is like 2360 on the E-mini. If I measure it here to here, the 618 would probably be like 2368 or 2369. And then if I measured here to here, the 618 would probably be like 23 in the 2370s. So yeah, that's just like the preference of it. But either way, it's just you giving yourself an idea of the probabilities. And it's interesting to note that from here to here, we came out of the level last week, so we closed below the 382. So now there's a higher probability that we're going to head lower. But it's also interesting to note that if you take this swing here to here, which is the net last swing high we had, we're at like a 50% retracement for that as well. So there's like the Fibonacci's, like just the law of numbers and all that stuff. Yes, Zach. I think you should. I think because I'm always trying to enter a trade when it's retracing, right? I think the best time to enter a trade is after the first impulsive move happens. Once it starts retracing in the opposite direction, that's the time. That's like the best time to enter. So yes, even on the dailies, even if I'm day trading and there's an impulsive move that happens, I will sometimes use the Fibonacci retracement levels, because if I think that impulsive move, there's going to be a second impulsive move in the same direction, I want to enter on the retracement of the first impulsive move, right? I don't want to be buying into the teeth of the first impulsive move. I want to be buying in when the first impulsive move ends and we start retracing in the opposite direction. That's when I want to be buying in, under the assumption that there's going to be a second impulsive move in the same direction as the first. They're good for all. They're good for all, Regan. I did address that as well. But no problem. They are. I mean, the fibs are going to work for everything. You just need to make sure you understand how to use them, because it's not like it's never going to be an exact science, right? It's never going to be like, you're never going to be able to say, okay, as soon as this gets to X level, then it's going to start going down. Like, you can never be like, okay, as soon as it gets to 2355, I'm going to enter it because it's going to start going back down again. No, that's not how it works. It's just like, kind of gives you the strike zone, right? Like, okay, this first impulsive move. Now, after this first impulsive move, we're going to retrace, and then I'm assuming that there's going to be a second impulsive move down. So, if I'm assuming that there's going to be a second impulsive move in the same direction of the first impulsive move, then I want to enter the first impulsive move on a retracement. That's all it is. And that's how I look at my trades and how I want to enter my trades. I want to enter my trades on retracements. And, I mean, guys, we can just keep going over this. This is fine. I think it's better to be really detailed about covering one thing than it is to cover a bunch of stuff and not being as detailed. So I want to make sure that everyone we get all the questions out before we move on. All right, I'm glad you got it now, Zach. So yeah, the 618. So you got it. All right, that's good. Wow, we've been talking about Fibonacci's for a while. But I like this, so it went by pretty fast. But I think we've got like 15 or 20 minutes left. So I guess we'll talk about implied volatility next week. I think it's really important as an option trader. We have to be aware of implied volatility and what options and stocks are the best ones to be trading, the best stocks to be trading are stocks with higher implied volatility. So I do have that in here, but there's not. I'll just share it with you guys at the end. There's not really a lot of. This is going to take too much time to cover today. So I'm just going to put it in here. There was like a screenshot of me screening for the volatility index on Thinkorswim. So like, and I sorted it, right? I did an ascending sort by the volatility index. And this basically giving us the most volatile stocks that we can trade options on. And I just did a very simple screen of a minimum $15 and minimum 350,000 daily volume average. And it gives you a list of stocks at the highest volatility index, which are going to be the best stocks for us to be trading. Trip, I used to have Trip on my watch list. MPEL, yeah, MPEL is a great. So MPEL is another one of those casino stocks, gaming stocks like Wynn, MPEL, Las Vegas Sands. But MPEL and Wynn are awesome. They're both very volatile. And that's what you want as an option trader. You want big price swings. That's how you make money on options. So I think in chat last week, somebody was asking about McDonald's. McDonald's is like the exact opposite of the exact opposite of a stock that you want to be trading as an options trader, because it's not very volatile at all. I basically like any Dow stock. If you're like, there's pretty much almost no good Dow stocks to be trading options on. None of them are that volatile. They're all like bonds, right? And McDonald's trades more like a bond most of the time, meaning that because it pays a dividend, it's almost like a bond with that. It's just not volatile at all, because it's just like it's hard to explain, but it's just like a stock that's so there's no growth. It's just like a steady company that's not doing much besides, just doing what it's doing. It's not like growing. It's not obviously not going to be moving much, and it pays a dividend. It's just those types of stocks you kind of want to stay away from as an options trader. You want to be trading things that are having big price swings. So I'll share this PowerPoint, but we're not going to be able to. We just don't have enough time to go over all this stuff right now. But we'll touch on implied volatility and the VIX next week. I'll make sure we go over that first. I really wanted to give an example of a trade that I feel like is a properly planned trade that everyone can take out of this and be like, okay, this is what I'm going to do. This is my blueprint for entering and planning a trade moving forward. And then I want to make sure we do some questions. Let's see. Okay, fatpremiums.com. Never heard of it. I will check that out. That sounds useful for sure. One that I have is iVolatility, but most of their stuff you got to pay for. But they have a thing there as well. So I wanted to just look at this. Now, Netflix, that's another great. Netflix has a lot of implied volatility. That's a great stock to be trading options on. So I'm doing an example of this on Netflix. Now, obviously, I'm bearish. My outlook on the market's bearish. I think we're going to make another leg lower. After I just showed you guys the retracement levels, how we closed below the 382 on Friday. We retraced the 50 and then closed below the 382. That means the probabilities are now a lot higher that we're going to make another leg down here in the next coming weeks, okay? Because we closed outside of the Fibonacci's last week. We retraced and then closed below that zone. So the probabilities are now in the bears' favors for more weakness to the downside. And we should be watching the 50 SMA on the S&P as well as 2300. Those are key levels of support. Okay, but that's just why, I'm bearish, right? So my outlook's bearish. This is how I'm going to structure a trade, planning for everything, okay? Now, I've also driven this home plenty of times. I'm going to do it again. Every time we enter into a trade, the first thing we should be looking at is our risk and our stop, okay? What's going to happen if this trade goes against us, okay? Because human nature is like when you get into a trade, from the beginning, if you're like a beginner, that when you get into a trade, you're like, oh, I'm going to make this much amount. And you don't even think about your plan if it goes against you. And then what happens is you end up holding for way too long, and you end up really hurting yourself when if you just planned for a stop and you planned for how much you're willing to lose, you could have got out of that trade and saved yourself a lot more pain. So Netflix right now is at about 142. Here's the chart. It's at 142, right? So I'm going to structure this trade here. Like I said, the first thing I'm identifying is my stop. So my stop's going to be a close above 144 on the daily, which is the March 22nd high, right above there. I'm risking $2, right? Because it's at 142. My stop's at 144, close above that on the daily. I'm risking $2, all right? Now, I want my reward to risk to always be 2 to 1, so that means I want to make at least $4 to the downside. Okay, but I'm risking 2, and I'm assuming that I'm buying a 50 delta put. And just use an example, the put's 250, right? If I have a $10,000 account, I want to be risking a max of 5%, okay? And this is assuming that I'm going out 30 plus days in expiration, okay? This is assuming I'm going out 30 plus days in expiration and I have a 50 or higher delta. This is what I'm doing here, okay? And obviously the put's probably going to be a lot more than 250, but this is just an example. So I'm risking a max of 5%. This means that I'm going to be buying 2 puts for $500. Now we could actually, we're actually risking 2%. So let me fix that because we're putting 5% of our account into the trade, but we're actually risking 2%. Which is fine. So we're buying 2 puts at $250 each for $500, which is 5% of a $10,000 account. Now, our stop is if Netflix goes up $2, which is $1 on the option. So we're risking $200. Okay, we're putting 500 into the trade, but we're risking 200. So we have a 2% loss. Okay, now I was saying you could ratchet this up to 1,000, right? And we could risk 5%. So we could buy 4 puts for 1,000, and then it'd actually be a 4% loss, right? Because we'd be losing 400. So here, let's change that a little bit. Let's buy 4 puts for 1,000 and risk 4%. Right, so you guys see, actually, these are numerous examples, so this is actually pretty good. Okay, so here, if we have a $10,000 account, if we're going to risk a max of 2%, then we're going to buy 2 puts for $500 because we're risking about $1 on the option, right, because the delta's 50. And because we're risking about $1 on the option because it's a $2 stop on Netflix, 144. So this is a 2% risk because we're putting 500 into the trade and we're stopping out at a $200 loss, 2%, okay? Now, we ratchet that up to 4%. I think this is a good, if we have a $10,000 account, we're going out at least 30 days in expiration or more. Then it's putting 1,000 into this, not super risky. So here we're saying, okay, we're risking 4%. We're going to buy 4 puts for $1,000. We're still risking $1. Now we're risking 400. Which is a 4% loss. So you see how if we're not necessarily risking everything we put into a trade, okay? We're putting 1,000 into this trade, but we're risking 400 of that 1,000. And what I was saying is if you're trading weeklies, you should just be assuming that everything you put into that trade is at risk because it's so risky. Now, if you go out over 30 days in expiration, you can assume that not everything you put in that trade is at risk. So there's a difference there. Okay, so yeah, I mean, this is a good example, right? So now I have my stop and my risk down, right? I have that identified. That's the first thing I'm doing. I'm identifying my risk and my stop. It's 144. It's a $400 loss on $1,000. It's a 4% loss on my $10,000 account. That's what I'm risking, okay? And obviously I'm making sure I'm going out 30 plus days in expiration with at least a 50 delta. Now, my target, right? If I want a 2 to 1 reward to risk, why do I want a 2 to 1 reward to risk? Actually, I should have put this in here, and I'll just put it in here for you guys. I want a 2 to 1 reward to risk because I only need to be right 33% of the time to break even if I always keep my reward to risk 2 to 1. Okay. Meaning, right, so I'm risking $2 on Netflix, the stock. That means I want it to drop at least 4 to 138. Which, do I think it can drop to 138? Yes, I think it could drop a lot more than to 138. Easily. There's this gap right here that still needs to fill, just like 136. So yeah. So yeah, I mean, I think it can get down to 138 or even lower within the next 30 plus days. So that's kind of how I'm structuring this trade. And then, okay, so now let's assume, now this is the key part of this trade where a lot of people struggle with, and I can understand why a lot of people struggle, because this is probably the hardest part of trading, is knowing when to take your profits. I feel like is the most complicated part of the trade. So this is what I always do. This is an example, right? So let's make sure, let's say instead of moving, it moves down $4, it moves down $2, right? So it moves down 2 in like a week, it moves down to 140. Okay, now if it's down to 140, we're going to have some profits in there, okay? Now I want to make sure that I guarantee myself that I take those profits. So now we're going to adjust our stop, okay? We need to move our stop down at a point at which we're guaranteeing ourselves that we're going to actually take profits and we're not risking we're not going to lose money on this trade, okay? Professionals take profits. So as soon as we get a $2 move down and it's at 140, we're going to make sure that we adjust our stop to guarantee ourselves profits, okay? Accordingly. And that's kind of an example of a properly planned trade, okay? Does anybody have any questions on that? All right, Zach. So if you have a debit spread, you're at max profit when the stock gets above the top strike or bottom strike, right? That's when you're at max profit. So, and it depends on the spread. Your max profit on the spread is the spread. So if you buy say if I did a 142, 144 put spread, right? A put debit spread. So say I did a 144, 142 put debit spread on Netflix. Where are we at? Let's just go to this. Let's say I did let's say a 143. So let's say I did a 143, 141 put spread on Netflix. Okay, my max profit is when it goes below 141. That's my max profit. And my max profit is just the spread between the two. So a 143, 141 put debit spread, my max profit's $2. And my profit's capped when it goes below the bottom strike of 141. And it works the same way with call debit spreads. Credit spreads, you want the option to expire above the top strike on either side. Or for a put, you want it to expire above the top strike. For a call, you want it to expire below the top. Not the top strike. Yeah, the top strike. So for a put, say we did a put credit spread on Netflix. Let's say I did a 141, 140 put spread on Netflix. I want it to expire above 141. When that option expires, it needs to be above 141 for me to have max profits. You want both in a credit spread. You want both the options to expire worthless. That's how you get max profits on a credit spread. Yeah, I'm gonna I'll share the slides in the chat. I'll share the slides in the chat so everyone can get them. So let's see. We got like 5 more minutes, guys. We're at a little bit over 60 minutes now. Does anybody have any other questions? Thanks, Regan. Yeah, I'll definitely share that. I'm glad that was helpful. I'm not sure if I don't think I ever made slides like that, Regan, a checklist or anything like that. I did go over like MACD and technicals, indicators and stuff like that. Okay, so Zach's saying he doesn't understand when to close a spread. So Zach, there's no requirement on when you need to close your spread. It's all like, you're not going to get, if you have a spread, you're not going to get max profit until expiration. Now, if you have a spread, say you have a debit spread on Netflix, that 143, 141. Okay, let's say you have this 143, 141 puts debit spread, right, on Netflix that I just told you about. 143, 141 put debit spread. Okay. And you go out 30 plus days. Now, let's say Netflix closes below 141 next week, and you still have like over 30 days till expiration. You're gonna have a lot of profits in there, not max profits, but you're gonna have a lot of profits. For me, I would rather just take the profits and not hold it till expiration. If it gets below the bottom strike on the put spread before expiration, I always just take the profits. I don't hold till expiration because there's just so much risk that it's going to come back and you're going to lose your profits. So me with spreads, if I go out longer term in spreads, I'm almost never going to hold it till expiration. If I get my move, I'm going to take my profits and move on. So there's no like requirement on when you hold it. Some people want to hold it till expiration. That's not me. I'm going to take my profits when they're there. So if I got that 143, 141 put debit spread on Netflix and I go out 30 plus days and next week it falls below 141 and I'm going to have some good profits in there, I'm taking those profits. I'm not waiting until expiration. I'm taking those profits and moving on to the next trade. Now with put spreads, usually with puts, I don't like to spread puts unless I go out really far. So with puts, I'm more apt just to buy a put instead of a spread, just because I don't want to necessarily be capping my downside, or I don't want to be capping my upside on the profits, and I don't want to be capping the downside potential of the stock. So usually when I buy puts, I'll just buy a put, unless I go out if I'm going out more than 2 months, then I'm spreading I'm always just going to spread in either direction, just because there's so much time value in the strike that I'm selling that I want to use that to my benefit. Because when you're shorting, you're shorting time as well. So it's, I just don't want to buy. It's just too expensive to go out that far. There's too much time in there. So, but inside of 2 months, if I'm gonna buy a put, usually I'm just gonna buy a put and not spread it, because you just have more upside. But that being said, if I did buy a 143, 141, I'm not going to wait until expiration. If it goes below 141, I'm going to sell and take my profits and move to the next trade. Yeah, I mean, that's generally how I operate, Regan. Yeah. And, when the market sells off, it's just an impulsive, very fast, much faster type of move. Sell-offs are just impulsive, much faster, and happens, a lot quicker. And yeah, that's why I like to just buy puts outright if I'm inside of a couple months. And then when I'm buying calls, I usually always do a call spread, no matter what, just because the market grinds higher, slower. So can I share my thoughts on SPX versus SPY? I mean, they're the same thing. It's the same exact thing. The SPY is just the S&P 500 ETF. So it's the same exact thing. It's just a different, it's just priced lower, it's in the hundreds or whatever, or in the 200s. But they're going to move the same. I just use the SPX because that's what everyone looks at. Like the key levels in the SPX are always important to be aware of. So yeah. Yeah, but it's the same. It's the same thing. Their market caps should be the same. It just the SPY has way more outstanding shares, so they're like the same thing. It's like the same size, because it has more shares outstanding. Like if you did the shares outstanding times the price of both, it should be the same. I'm pretty sure. Yeah. The SPY, the IWM, QQQ, those are all really good ETFs to trade. IWM is going to be like the IWM's, in my opinion, is the best ETF to trade, the best index ETF, because it's the highest implied volatility, so it moves the most. The 50 and then the 100 and the 200. I usually don't have the 100 on there. I usually have this. I usually use the 17 EMA as like a shorter term. I had the 100 on here because I was looking at the VIX, which we didn't even get to go over that. But the VIX is like coming close, approaching. It's way above its 50-day average, right? The VIX has been like all-time lows. 11 just crazy, but the VIX has popped recently. If it gets above 14, we could probably head higher. I mean, the market will head lower. The VIX can do some crazy stuff, but yeah, I mean that's why I had that on there, because I just want to see the 100-day average of the VIX, which is 1264. Usually I use the 17 EMA as my short term. Well, this is usually the moving averages I use: the 50, the 200, and 17 EMA. Yeah, no problem. Have fun at hockey, Zach, and you asked some good questions. Good job. Good job. Regan, yeah. So the IWM is like, they say, the privates lead the generals. So yeah, the IWM a lot of the time is going to be a leading indicator. A lot of the time. And it was on the Trump rally that we had. It led the way. It led the way up, and it started leading the way down as well. And in my opinion, it's just the best. It's the best index ETF to trade because it's the most volatile. It has the highest implied volatility. And yeah, the SPY is good as well. QQQ is pretty good. But I like the IWM. That's what I play with the most out of all the index ETFs. So but yeah, I know, Regan, you asked about like what to prepare for like the market, but it's really just stocks with high implied volatility that haven't fallen a lot yet. Netflix, Tesla. I mean, you got them down. It's really just what do you want to use as a vehicle to ride the market down when it goes lower? And what I want to use to ride the market down when the market goes lower are like these big tech companies that are way overvalued, because those are the ones that get slaughtered the most, that have really astronomical PE ratios. And even in Tesla's case, Tesla's not making any money yet. So stocks like that will get pummeled when the market corrects. They're like the best vehicles to use to ride the market lower. And then for indexes, IWM is what I would use. So, I mean, you pretty much have everything there. Also, biotech will get crushed pretty hard too when the market goes down. Just the more volatile sectors. So probably Celgene wouldn't be a bad one as well, or IBB. But yeah, I mean, Netflix, Tesla, probably IBB, Celgene, IWM. And then oil too, because I'm bearish on oil this year. So I want to throw in a couple oil, like Chevron. I know I covered this a couple videos ago. I covered Chevron. Chevron's still my favorite bearish idea of the year. It was at like 110 when we started talking about it. It's at like 108 now. It's had support from its dividend, but if oil keeps going down, Chevron's gonna head lower. And we can just look at that real quick to end this. But those are the kind of things, right? I have some bearish exposure to oil, and then just high beta, high moving tech names in the IWM. Let's see here. So last year, Chevron got all the way down in the 80s. and it can easily go there again. And this was when oil was in the 40s. Chevron got down to the 80s. So I still like, this is still my favorite trade of the year, is bearish put debit spreads on Chevron with an expiration of like January 2018. That's going to be like a trade that I'm going to be making here shortly, probably sometime in April. I'll probably be buying probably the 110, 100 January 18 put spreads is what I'm probably going to be starting to buy on Chevron in April. And I'm not going to buy it all at once. My longer term trades I leg into, so I'm not going to buy it all at once. I'm going to buy some, and then if it goes higher, I'll still buy more, and then if it goes lower, I'll add to it as well. And then my stop will probably be somewhere around 115. But yeah, I mean, so those are the things, right? I want some exposure to some oil companies, IWM, some tech names. That's kind of all the stuff that I'd be wanting to use as my vehicle to ride the market lower if we go lower. And I think that is going to be it for today, guys. So everybody enjoy the rest of their Sunday. And I'll see you guys in chat on Monday. I think this was a good session. I'm glad, we got to talk about some important things. And I hope you guys were able to learn from this. And everybody, like I said, enjoy the rest of your day.